The construction of new minimum standards to enhance banks' liquidity buffers is now well advanced, but it does need some remodeling before completion. The current definition of high-quality liquid assets is too narrow, focusing only on sovereign debt and cash. This may have the unintended consequence of increasing segmentation and reducing liquidity in some financial markets. Consideration should be given to broadening the definition to allow for a continuum of asset types with suitable haircuts and limits. With additional protections for global SIFIs agreed, work is now underway to extend extra resiliency requirements to banks that are not globally systemic, but are systemic nationally or domestically. This includes developing an appropriate methodology for identifying domestic SIFIs and outlining prudential measures to mitigate the risks they pose. Given the significant differences across countries in the structure of national banking systems, this framework should adopt a principles-based approach so that regulators have some flexibility to focus on the additional requirements that will be most effective within their domestic context. The systemic risk posed by other types of financial institutions and financial infrastructures is also being reviewed. This includes systemic activities of life insurance companies, financial markets infrastructures such as central counterparties, and non-bank financial firms, or so-called shadow banks. So let me say a few words about shadow banking. Drawing the systemic elements of shadow banking into the regulatory net was a central element of the G20 reform vision. The leaders agreed that regulation and oversight should depend on the nature of the activity, not on legal structure, and that like activities should get like treatment. In many countries, including Canada, market-based financing or shadow banking is at least as large as the traditional banking sector. Shadow banking spans a range of activities, including repurchase agreements, mortgage-backed securities, other types of securitization, short-term debt instruments, and money market mutual funds. The sector provides competition to traditional banking, and it's an important source of diversification and innovation. But it also entails many of the same risks that are inherent in traditional banking. Like the credit intermediation of banks, shadow banking involves liquidity and maturity transformation, often with some degree of leverage. Moreover, as the financial crisis made painfully clear, the systemic risks in the shadow banking sector can be magnified by the interconnectedness of the financial system. Stresses in the shadow banking sector can be transmitted to the core of the financial system in unforeseen ways. Foundational elements to achieve more comparable treatment are now in place, including enhanced disclosure requirements, the new consolidation accounting standard, and minimum risk retention rules. But much work is needed on the full range of policy options to control systemic risks in the shadow banking sector. These include direct regulation of the activities of shadow banks, indirect regulation via links to the traditional banking sector, targeting specific products, and various macroprudential measures. By the end of this year, 2012, the FSB, with the relevant standard-setting bodies, will develop policy recommendations on shadow banking in 5 priority areas: the interactions of regulated banks with shadow banks, money market mutual funds, other shadow banking entities, securitization, and securities lending and repos. Policy reforms in all these areas should be guided by 4 considerations. First, with the capital and liquidity standards applied to banks set to increase, we can expect to see new incentives for activities to migrate to the shadow banking sector, increasing the need for timely reform. Second, the reforms must strike an effective balance between the benefits of shadow banking in terms of competition, innovation, and diversification, and the risks related to regulatory arbitrage and systemic vulnerabilities. Third, given the important differences in the structure of shadow banking activities across countries, the best means of mitigating systemic risks are likely to differ across jurisdictions. But given that shadow banking activity crosses national borders, it will be important that there is a coherent global approach. And fourth, Reforms and the approach to monitoring the sector must be flexible and adaptable. Changes in regulation and innovation can lead to the rapid expansion and mutation of shadow banking activities. The final element of the comprehensive reform plan is mitigating contagion between sectors and institutions in the financial system. The House needs firewalls. Recognizing this imperative, the G20 leaders mandated that all standardized OTC derivative contracts should be traded on exchanges or electronic trading platforms where appropriate and cleared through central counterparties or CCPs. In addition, all OTC derivatives trades should be reported to trade repositories. The architecture for trade repositories is converging on a global platform, although there are still some important issues related to data access. For CCPs, the basic architecture has yet to be resolved, and there are two competing designs, global and local, and each has its costs and benefits. The global design has the greatest potential to reduce fixed costs, maximize netting benefits, and economize on collateral. At the same time, these very benefits would concentrate clearing risk in a small number of very large global CCPs, and they could also create a competitive advantage for the largest global banks, which could serve to reinforce their systemic importance and work against other reforms. The alternative is a more distributed model in which local CCPs are established to clear OTC derivatives outside the United States and the European Union. While this design would reduce concentration and provide for greater competition, it could result in an overly fragmented architecture with local CCPs that are not sufficiently efficient or robust. To inform decisions on architectural design, the FSB, working with the standard setters, is coordinating efforts to develop adequate safeguards for a global architecture, especially with regard to access, cross-border emergency liquidity arrangements, cooperative oversight, and resolution. The goal is to complete the work on these 4 safeguards by this June so that each jurisdiction can make an informed decision about its preferred architecture by the end of this year.